What if the safest asset on planet Earth just stopped feeling safe, and almost nobody told you? Somewhere between Wednesday afternoon and Friday's closing bell, more than $500 billion in American wealth quietly vanished. And the people who are supposed to prevent exactly this are now locked in a weekend argument they never expected to have. If you want the full truth about what just happened to your money, take 2 seconds right now and hit subscribe. Tap that like button and send this video to one person who still believes the Federal Reserve has everything under control. Because after the next few minutes, you will never look at your mortgage statement, your paycheck, or your retirement account the same way again. Let me take you back to Wednesday. Most Americans ended that day the way they end every day. They cooked dinner, checked their phones, watched something, and went to sleep. They saw a red number on a news ticker and shrugged. Markets go down sometimes. That is normal. But this was not normal. Wednesday, July 29th, 2026, was the worst single day for the Dow Jones Industrial Average since April of 2025. The index collapsed by 1,153 points. The S&P 500 dropped 1.52%. The Nasdaq fell 1.74%. But here is the part almost nobody understood. The stock market crash was not the story. The stock market was simply reacting to something far more serious happening underneath it, in a market most people never think about, but which controls almost every dollar in their life. To understand that, we have to start with the Federal Reserve's decision that morning. The Fed held interest rates steady for the 7th month in a row. The target range stayed exactly where it has been all year, at 3.5 to 3.75%. On the surface, that sounds boring. A central bank doing nothing is usually the least dramatic thing in finance. But inside that decision was something historic. 3 Federal Reserve officials voted against the chairman, and they did not vote for a rate cut. They voted for an immediate rate hike. Beth Hammack of Cleveland, Neel Kashkari of Minneapolis, Lorie Logan of Dallas. 3 of the 12 voting members formally, publicly, and permanently placed their disagreement into the official record. 3 dissents in the same direction has not happened since September of 2016. That is 10 years. This was not a polite policy debate. This was a rebellion. Then Chairman Kevin Warsh walked to the podium and did something that shocked professional traders around the world. He ended forward guidance. For years, the Federal Reserve has told markets roughly where interest rates are heading. It is a tool. It calms people. Banks plan around it. Businesses budget around it. Home buyers depend on it indirectly. Warsh refused to give it. He would not say whether rates were going up, down, or nowhere. He essentially told the entire global financial system to figure it out alone. And the bond market answered him immediately, while the cameras were still rolling and while he was still speaking. The yield on the 30-year United States Treasury bond spiked to 5.21% during his press conference. By Friday, August 1st, it had climbed to 5.28%. That is the highest level since July of 2006. Think about how long ago that is. The last time long-term American borrowing costs were this high, the iPhone had not been released, social media barely existed. An entire generation has grown up, gone to college, and started families inside a world of cheap money that just ended in front of our eyes. The 30-year fixed mortgage rate followed immediately, climbing to 6.58%, the highest in nearly a year. Then Thursday morning arrived and made everything worse at the same time. The second quarter gross domestic product report showed the American economy grew at just 1.5% annualized, down from 2.1% the previous quarter, and below every major forecast on Wall Street. A slowing economy is bad enough, but hidden inside that same report was the gross domestic product price deflator, the broadest measure of inflation the United States government produces, and it surged at 6.3% annualized. Personal consumption expenditures inflation hit 5.1% on a quarterly annualized basis, the worst reading since 2022. Year-over-year headline PCE rose to 3.8%. Core PCE sat at 3.3%. Growth was slowing. Prices were accelerating. That combination has a name, and economists say it the way doctors say the word tumor: stagflation. Before we go deeper into why this is so dangerous, do me one small favor. If this explanation is already clearer than anything you have heard on the news this week, drop a single word in the comments: awake. It takes 3 seconds, it tells the algorithm real humans are watching, and it helps this warning reach families who genuinely need it. And if you have not subscribed yet, now is the moment, because what comes next is the part that actually affects your bank account. To understand why the bond market reacted with such violence, you have to know what Kevin Warsh promised before all of this. In his congressional testimony as the new Federal Reserve Chair, Warsh did not speak like a typical central banker. He was blunt. He called inflation a tax on the American people and on American businesses. He promised regime change in Federal Reserve policy, openly criticizing the failures of those who came before him. He said 5 years of above-target inflation would become a thing of the past. And then he said the line markets remembered most. He said there's no soft inflation target, not on this committee's watch. There's only a target, and it is 2%. Those were the strongest anti-inflation words spoken by any Fed chairman in more than a decade. Markets treated them as a promise, and then they waited. Wednesday was the day the bond market delivered its verdict on that promise, and the verdict was brutally simple. Talking tough is not the same as acting tough, because while Wersch was delivering powerful speeches about defending the currency, the actual policy rate had not moved in 7 months. It did not move while inflation stayed above target every single month. It did not move while the GDP deflator hit 6.3%. It did not move while quarterly PCE accelerated from 4.6% to 5.1%. It did not move while mortgage rates climbed towards 7%. And it did not move even when 3 of his own colleagues said the hold was no longer defensible. The bond market looked at all of that and drew one conclusion. It saw a chairman who speaks like Paul Volcker but acts like Arthur Burns. Those 2 names decide everything. Paul Volcker became Federal Reserve Chairman in 1979 when inflation was destroying the country. Volcker did something almost no policymaker has the stomach to do. He raised interest rates to 20% in 1981, 20%. He knew exactly what it would cost. It caused a severe recession. Unemployment surged. Farms failed. Small businesses closed. Construction stopped. People hated him. Congress attacked him. But he refused to break. And because he refused, inflation died, and America received nearly 30 years of stable prices and global trust in the dollar. Volcker proved something permanent. Credibility is not built with speeches. It is built with pain that you are willing to accept. Arthur Burns is the opposite lesson, and it is the one being taught in every economics classroom in the world. Burns ran the Federal Reserve through most of the 1970s. He was intelligent, respected, and extremely well-spoken. He gave speeches warning about inflation constantly, but every single time the economy softened or markets fell or political pressure grew, Burns backed away. He eased too early. He waited for data that never cooperated. He kept believing inflation would fade on its own, and because of that hesitation, inflation became embedded in the psychology of an entire nation for a full decade. Prices rose, wages chased them, and businesses raised prices again. That spiral cost America 10 years of lost economic ground. Wersch has publicly said he understands the Burns mistake and refuses to repeat it. The bond market has not yet seen him prove it. That is exactly what 5.28% means. It is not a prediction that Wersch will never act. It is a bet that he will act too late. And late is expensive. You can see how fast confidence shifted. Before Wednesday, the CME FedWatch tool showed roughly 82% odds that the Fed would simply keep holding rates in September. After Wednesday's chaos, the market flipped to a 59% probability of an actual rate hike. That is a swing of about 40 percentage points in under 96 hours. Markets do not move like that on economics alone. They move like that on trust. And this week, trust cracked. Now let me translate all of this out of financial language and into your kitchen table. Most news programs obsess over the Fed funds rate. But the rate that truly rules your life is the 30-year Treasury yield, because it directly anchors 30-year fixed mortgage rates with almost no delay. When that yield hit 5.28%, mortgage rates hit 6.58%. Let us make that real. Picture a family buying a $400,000 home with 20% down, borrowing $320,000. At 3%, the rate available in early 2021, their monthly principal and interest payment would be about $1,348. At 6.58%, that identical home in that identical neighborhood with that identical kitchen cost about $2,195 per month. That is a difference of $847 every single month for 360 consecutive months. Over the life of the loan, it is roughly $304,920 extra dollars. Stop and absorb that. That family is not paying $300,000 more because the house improved. They are paying it because the bond market no longer trusts the Federal Reserve. That is what I call the credibility tax. It is invisible, it is silent, and it is paid entirely by ordinary people. Every single week, the 30-year yield stays above 5%. That tax quietly compounds across the whole country. It shows up in mortgages. It shows up in car loans. It shows up in business loans. It shows up in credit card rates. And it shows up in the federal government's own borrowing costs. That last one deserves special attention because it is where this becomes a national problem instead of a personal one. The United States Treasury must issue an enormous volume of debt each year, both to fund deficits and to roll over maturing bonds. At current issuance levels, every single basis point of higher long-end yield adds roughly $1 billion to annual federal interest costs. So when yields jump by 50 or 60 basis points in a matter of weeks, the government suddenly owes tens of billions more in interest that nobody budgeted for. That money does not appear from nowhere. It comes from taxes, from spending cuts, or from more borrowing. And more borrowing means more bond supply, which pushes yields even higher. That is a loop, and loops are how financial systems break. Let us slow down for one moment. If you are still with me, you are already ahead of almost everyone around you, because most people will never sit through an honest explanation like this. So here's my simple ask. Hit the like button, because it genuinely helps this channel survive against the machine of financial noise. And share this with your spouse, your parents, or your business partner. Understanding this alone is useful. Understanding it as a household is protection. Now let us go back into the data, because the GDP report deserves a much closer look. Growth slowed to 1.5%, and the weakness came from two places. Federal non-defense spending contracted by 4.1%, and imports surged 11.5%, while exports grew only 4.5%. A widening trade gap mechanically subtracts from headline growth. But here's the twist. Underneath that weak headline, the private economy was actually strong. Consumer spending grew 3.2%. Real final sales to private domestic purchasers, one of the cleanest measures of true underlying demand, grew 3.9%. So the American consumer is still spending aggressively while the headline number looks weak. That is the exact recipe that keeps inflation alive even as growth appears to fade. And that is what makes the inflation numbers inside that same report so frightening. The GDP deflator at 6.3% is the broadest possible reading of economy-wide prices. Quarterly PCE accelerated for the second straight quarter. Year over year, headline PCE rose to 3.8%, moving away from target rather than toward it. Only one number improved. Core PCE decelerated on a quarterly basis, one number. And that single improving number is exactly what the chairman and the 9-member majority used to justify another hold. 7 months of patience, defended by one cooperative statistic surrounded by a dozen alarming ones. The bond market noticed. Traders are not required to be polite. They simply priced the risk. Now, why is this specific week different from every other scary week in recent memory? Because there have been hot inflation prints before. There have been Fed holds before. There have been dissents, bad market days, and weak GDP reports before. What makes this week structurally different is that all of it arrived at once, inside roughly 72 hours, during the first genuine policy test of a brand new Federal Reserve chairman. A historic three-way descent. A GDP deflator at 6.3%, a 30-year yield at a 19-year high, mortgage rates at a 12-month high, a Dow collapse of over 1,100 points, and accelerating quarterly inflation. That is not a bad week. That is a stress test of the entire monetary framework, and the results came back mixed at best. Wall Street noticed the internal fracture immediately. Strategists pointed out that the committee now has loud, credible hawks, while the majority still stands with the chair. Man for now. Everyone agrees on one thing. September is a live meeting, and every inflation report between now and then is the whole game. Others were blunter, noting that Warsh essentially invited a genuine internal debate when he took office, and he now has one that is fully public. Hammack, Kashkari, and Logan did not grumble privately. They put their names on the record forever. That changes the politics inside the institution. If the next inflation report runs hot, 3 dissenters can easily become 4, and 4 can become a majority. If energy prices bounce again on any escalation overseas, the case for hiking becomes overwhelming, and the chairman has boxed himself in with his own language. He called inflation a tax. He called it an attack on families and businesses. He promised regime change. Those are not neutral phrases. Once a central banker says them, he owns them. The bond market understood exactly what those words committed him to, even if he was still hoping for flexibility. 5.28% is the market saying, we heard you, and now we are pricing your timeline instead of your intentions. There's another layer that makes this inflation wave especially dangerous, and it comes from geopolitics. The Iran conflict began on February 28th, 2026, 5 months before this week. When an energy shock hits an economy, it travels through 2 separate channels. The first is direct and fast. Gasoline, diesel, heating fuel, electricity, and jet fuel all rise with oil. Everyone feels it within days. The second channel is slow, quiet, and far more damaging. Every product made in a factory, moved by a truck, stored in a warehouse, or cooked in a restaurant uses energy somewhere in its journey. It takes months for those higher business costs to reach the final price tags consumers see. The second quarter data, covering April through June, captured that second wave arriving in full force. Headline PCE surging at 5.1% annualized is not just gas prices. It is energy inflation spreading outward into food, into manufacturing, into shipping, into services, into construction, into insurance, into almost everything. The GDP deflator at 6.3% is the number that captures that full spread. This is why hawkish Fed officials suddenly sound urgent rather than academic. Kashkari has warned that inflation staying above target for years is corrosive. Hammack has focused on the pressure persistent inflation puts on ordinary households. Logan has argued that modestly higher rates are simply appropriate given conditions. These are not fringe voices shouting from the sidelines. They are 3 of 12 voting members making a formal stand. Their argument is straightforward and hard to dismiss. You cannot allow 5 years of above-target inflation to quietly become 6 years without permanently damaging the credibility of the institution. Once the public stops believing in the 2% target, expectations shift. Workers demand bigger raises to keep up. Businesses raise prices in advance rather than in response. Contracts get written assuming higher inflation forever. That is the moment inflation stops being an event and becomes a culture. Volcker's entire life's work was proving that once you reach that point, the cure is far more painful than early action would have been. The chairman's counterargument rests almost entirely on core inflation, which strips out food and energy because those categories are volatile. In normal times, that logic is reasonable. But stripping energy out of the data during an active energy war is analytically clean and practically useless. A trucking company cannot fuel its fleet with core inflation. A bakery cannot heat its ovens with a statistical adjustment. A family cannot feed their children with a seasonally adjusted index. Businesses facing higher energy costs raise prices regardless of what the core index says. Workers watching fuel prices climb demand raises regardless of which measure the Fed prefers. The GDP deflator captures precisely what core deliberately excludes. That gap between the official narrative and lived reality is exactly what the bond market is pricing. Then comes the currency, which added another layer this week. The dollar index posted its worst weekly performance in 3 months. The mechanism is simple. When a central bank holds rates while inflation accelerates, the real inflation-adjusted return on holding that currency falls. Global capital notices instantly and moves elsewhere. A weaker dollar sounds abstract until you remember that a large share of American consumer goods are imported. Electronics, clothing, auto parts, furniture, appliances, pharmaceuticals, and countless components inside domestically assembled products all come from abroad. When the dollar weakens, every one of those items becomes more expensive in dollar terms, automatically, without any producer raising a single price. That imported inflation then appears in the next round of consumer price data as domestic inflation. And that creates the most dangerous loop in this entire story. Fed patience weakens the dollar. A weaker dollar imports inflation. Imported inflation pushes measured inflation higher. Higher inflation increases pressure to hike. Pressure to hike increases bond market volatility. Volatility raises long end yields, and higher yields raise the cost of everything for everyone. The loop feeds itself, and the dollar's worst week in 3 months is the signal that the loop has already begun turning. Some analysts believe Wirsch is doing this intentionally. The theory goes like this. By removing forward guidance, he forces the market to tighten financial conditions on its own. Bond investors, uncertain about the future, demand higher yields. Higher yields slow borrowing and cool the economy. In effect, the market does the Fed's dirty work while the Fed avoids the political cost of hiking. On paper, that is elegant. In practice, it only works if investors genuinely believe the chairman will step in and act, if inflation refuses to cooperate. If they suspect he is using them as a shield rather than a tool, the entire strategy collapses into pure uncertainty. 5.28% is the market testing which one it is. As one major bank economist put it plainly, the market is not questioning his intelligence or his competence. It is questioning his credibility, which is the single most valuable asset any central bank possesses. You have now made it further into this analysis than the overwhelming majority of people ever will, and that genuinely matters. So here's a different kind of request. Do not just like this video. Save it. Come back to it in September when the next Fed decision lands and see how much of this played out exactly as described. And if you want that follow-up, subscribe now, because that breakdown is coming, and it may be even more important than this one. So what do you actually do with all of this? Because understanding a crisis intellectually and positioning for it financially are completely different skills. This week handed us a very specific map. Not a prediction, a map drawn from documented market behavior under real pressure. It has clear winners, clear losers, and clear decisions. Start with housing, because it is where most American wealth lives. If you have been waiting on the sidelines for mortgage rates to fall, the data says stop waiting. There's no realistic near-term path to that outcome. If inflation stays hot into September, the Fed hikes, the 30-year yield could test 5.5%, and mortgage rates could push toward 7% or higher before year-end. If inflation cools meaningfully, the Fed holds, yields stabilize near 5%, and mortgage rates simply sit near 6.5%. Notice that neither scenario delivers cheap money. A meaningful drop requires the Fed to rebuild credibility it visibly lost this week, and credibility is rebuilt slowly across multiple meetings of consistent action. For buyers, the smarter approach is to focus on price rather than rate. In markets already showing softness, places like Phoenix, Austin, Denver, and Tampa, buying at a discounted price with a high rate can beat waiting. A lower purchase price locks in a lower tax assessment, a smaller loan balance, and less total risk. And a rate can be refinanced later. A price cannot. The single most expensive mistake in this environment is passive waiting for a rescue that the data does not support. Next, look at your debt, because this is where the damage happens fastest. Any variable rate borrowing is now a live threat. Credit card balances, adjustable rate loans, home equity lines, and business credit lines all reprice upward when rates rise. In an environment where the Fed may be forced to hike and where long yields are already at 19-year highs, carrying variable rate debt is like standing under a falling ceiling. Attack it, consolidate it, pay it down. Your goal is flexibility, because flexibility is the only real defense when the cost of money is unstable. Now the portfolio side. The clearest winner from this week is short-duration fixed income, specifically 2 to 3 year treasuries. Notice what actually happened Wednesday. And while the 30-year yield spiked, the 2-year yield actually fell 4 basis points. That is the yield curve steepening, and it carries a message. The market believes the Fed will eventually be forced to hike, cause damage, and then cut. Short-duration treasuries let you collect roughly 4.2% with minimal price risk while you wait for clarity. They're not exciting, they're simply reliable, and reliability is undervalued right now. The second winner is inflation-protected treasuries. Traditional bonds pay a fixed coupon that inflation slowly eats alive. Inflation-protected securities adjust their principal with measured inflation, so your purchasing power travels with prices instead of behind them. When the broadest inflation measure in the country runs at 6.3% and quarterly PCE accelerates, holding nominal long bonds is a slow, quiet loss. Inflation-protected securities are the direct hedge against exactly the risk this week, confirmed is still building. The third winner is gold, and this week the mechanism was unusually clear. Gold rose as the dollar posted its worst week in 3 months, because gold priced in dollars naturally climbs when the dollar weakens. But the deeper driver is credibility. Gold is the only major reserve asset with no counterparty. It does not depend on a government keeping a promise or a bank staying solvent. When central bank credibility is publicly questioned, sovereign demand for gold accelerates. Central banks have now been net buyers for 16 consecutive years, with projections of roughly 750 to 850 tons this year. Major global banks have issued aggressive long-term targets citing the exact drivers this week amplified: persistent inflation and dollar weakness. Now the losers, and honesty matters more here than comfort. Long-duration Treasury bonds face the most direct damage. When yields rise, existing bond prices fall, and the longer the maturity, the harder the fall. If the 30-year yield pushes toward 5.5%, everyone holding long bonds absorbs real mark-to-market losses. That includes pension funds, insurance companies, target date retirement funds, and millions of ordinary investors who never chose that exposure directly. Check what is actually inside your retirement fund. Most people never do. Real estate investment trusts are the second clear loser. These companies borrow long-term to finance property portfolios. Their entire model depends on the spread between rental income and borrowing costs. With a 30-year yield above 5%, refinancing math becomes brutal. As cheap debt from the low-rate era matures, it must be replaced at today's rates, compressing margins and threatening dividends. The sector has already underperformed through this normalization cycle, and this week added pressure rather than relief. The third loser is highly leveraged growth equity, especially in technology. The value of a fast-growing company is built on profits expected far into the future. Those future profits must be discounted back to today using current interest rates. And when long-term rates rise, the discount deepens, and distant earnings become worth less right now. That is not sentiment. That is arithmetic. The Nasdaq's decline on Wednesday was that arithmetic operating in real time. Companies priced for perfection have almost no room to absorb a higher for longer rate world. So here's the honest verdict on this extraordinary week. Kevin Warsh inherited an institution that had already failed to return inflation to target for 5 straight years. He promised something bolder than his predecessors. He used the strongest language any Fed chair has used in over a decade. He called inflation a tax and declared there is no soft target. Then, at his first true test, he chose patience, defended by a single cooperative statistic, while 3 colleagues publicly told him patience had expired. The bond market tested those words and found them, so far, insufficiently backed by action. 5.28% on the 30-year is not a vote of no confidence. That distinction matters enormously. It is a vote of not yet confident. The market is not saying Warsh will fail. It is saying it needs evidence, and it is charging America a premium until that evidence arrives. September 16th and 17th is when the evidence must show up. If inflation accelerates and he holds again, credibility erosion becomes structural, and structural damage takes years to repair. If inflation accelerates and he hikes, the initial shock could be followed by a powerful bond rally, falling long-term yields, and a housing market starting to thaw. That is the strange truth hiding in all of this. The painful choice is also the cheaper one. Volcker's brutality bought 30 years of stability. Burns's caution bought a decade of misery. Every day of delay looks compassionate and costs more. The credibility tax does not appear on any government form, but it is being collected right now from every home buyer, borrower, saver, and taxpayer in the country. You now have the full map. You understand why the bond market matters more than the headlines. You understand why your mortgage payment is really a trust measurement. You understand the stagflation trap, the dollar loop, and the difference between the words a central banker says and the actions markets actually price. Most people will spend the next few months reacting emotionally to headlines they do not understand. You do not have to be one of them. The bond market spoke on Wednesday. The economic data confirmed it on Thursday. The dollar agreed on Friday. And now the only question left is whether the people in charge are willing to hear it before the cost becomes permanent. Watch September closely. Prepare before then, not after. Because in finance, the people who lose the most are almost never the ones who guessed wrong. They are the ones who waited for permission to act. Now you know. Do something with it.